From New York City for our viewers worldwide, I'm Scarlett Fu, and Bloomberg Real Yield starts right now. Coming up, U.S. payrolls tumble in August with just 22,000 jobs added to the economy, sending bond yields plunging across the curve. Traders are now locking in a September Fed rate cut. We begin with the big issue, a labor market in stasis.
Another weak summer employment report.
This is a continued deceleration.
There's an ongoing sort of labor market slowdown.
We want a labor market that's cooling, that's not freezing.
U.S. growth is still good.
We are expecting the Fed to cut rates.
We don't think they have to do much more.
There's a lot of uncertainty, but there's a lot of complacency, I think, in the bond market.
This is not a bond market which is not functioning. It's a bond market that's repricing.
Government bonds are going to have a less important role to play in portfolios as diversifiers looking ahead.
The way we're looking at the yield curve is you're probably going to see a further steepening.
Bond investors are a little concerned about putting on too much of a steepener trade.
I'm not overly concerned on this run-up in yields.
The market, to me, feels like it's overpricing cuts between now and the end of next year.
The market's already pricing in the cuts.
Everyone is assuming that the Fed is moving to a place of easing.
If the Fed doesn't cut, that probably sets up a little bit of a pullback here.
All right, all the commentary on the jobs number. Let's take a closer look at those payrolls number because it was an eye-popping miss on the headline number. 22,000 jobs added versus a consensus estimate of 75,000. Now, after you fold in revisions for the last 2 months, we are looking at a loss of 21,000 jobs from previously reported numbers. As for the unemployment rate, that ticks higher to 4.3%, which is in line with what economists had been looking for. Average hourly earnings also stabilizes, gaining 0.3% in August. That's what we got in July as well. And average hourly earnings actually coming in a little bit lighter than what people had anticipated, or I should say 3.7% versus the estimate of 3.8%. Let's flip the charts and take a look at the 2-year yield over the course of this holiday shortened week. We did start the week higher, but since Wednesday, you could see a steady decline and then, of course, capped by a plunge today. At one point, the 2-year yield falling as much as 12 basis points. Now at the lowest since 2022. And everyone we talk to seems to like the short end, so I wonder to what extent that feels like a very crowded trade. Let's stay on the payrolls report because Jeff Rosenberg of BlackRock says the numbers highlight the tension in the Federal Reserve's dual mandate.
It's a weaker report, but it's a weaker report that solidifies 25. What it really puts on the table is a Fed that gets back in motion for cutting rates. And if the economy is not falling off a cliff, that's a pretty good combination for risk assets. Bad news is good news. Next week, other data will come out, and we'll focus again on the other side, which is the inflationary side. And so this is really the tension that you see within the curve.
Joining us now is Herr. She is U.S. CIO for JPMorgan Asset Management Global FIC, and Ian Lyngen, head of U.S. rate strategy at BMO Capital Markets. And what I thought was interesting here was when Jeff mentioned if the economy is not falling off a cliff. Kay, let me start with you. What's next for the economy? Are we thinking recession? Are we thinking stagflation?
No, we're in the soft landing camp, or as we fixed income people like to say, sub-trend growth. That's the same as soft landing for equity peoples. But actually, before we step forward, may we take a step back?
Please.
As I was walking up from our new corporate headquarters 270 this morning.
Beautiful building.
I was thinking about the last time I was on this show with you. And it was 3 months ago. And you may have forgotten because you're in it every single day, every data point. But 3 months ago when I was here, we were focused on a really hot number. It was, I think, 134,000. And that was the third consecutive, much higher than expected number. Now, subsequently, that was revised away to something like 19,000. So I don't think we should get too carried away with a specific data point. I'm more looking at what we see here is a slowing in job growth. We're not sure what the break even is to keep the unemployment rate steady, given everything that's going on. But this feels like a normal and healthy slowdown in job growth. On another level, it's not surprising because when I was here in June, we spoke about the lack of breadth in the employment growth. Those job gains were very focused on healthcare and education. Those together represent about 17% of overall employment. And yet over the last 3 months, they've represented something like 200% of job growth.
Interesting.
So this is, I think, why you're starting to see some revisions away.
And Ian, it is exactly those revisions that had you kind of skeptical heading into this jobs report as well. When you look at the data now, this report today, with a new head of economic statistics over at BLS, how skeptical are you of this latest print?
Well, one observation that I'll make is that the participation rate in the survey on the establishment side was the second lowest of the year. So that means that this number is also going to be revised. And so if we look at this number in concert with ADP, with jobless claims, it's telling a similar picture. My biggest concern was that we had a strong payrolls number and a softer ADP, and then the market would have discounted the BLS data even more. But now we have a clear message, and it is a message of cooling. It's not a message of contraction, at least not yet. My primary concern is there's a sentiment within firms and within hiring that has swung away from adding. Now we're at stall speed, and the question is the next leg actually shedding jobs? And that's when one would get worried about a recession over sub-trend growth.
But we're not there yet.
Not yet.
Okay, I mentioned BLS because obviously that's something that caught the president's attention last time around. And Howard Lutnick, the Commerce Secretary, was speaking about the new leadership at the BLS. Let's take a listen.
Donald Trump needs to rely upon the numbers. America needs to rely upon the numbers. You can't have these bent former administration people who have a view and who want to harm the president. We need accurate numbers coming from BLS. And finally, we'll have new leadership to deliver it.
Obviously, he's speaking from the perspective of someone who is, has the ear of the president and is speaking to the president in many ways. The August jobs report was weak. The July jobs report was weak, and the president was unhappy with that. But I'm not clear why the weak print was bad when it buttresses the case for a rate cut. I mean, it gets us to where the president wants to go, doesn't it, Kate?
Yes, but let's take a step back because you've asked about the BLS, and I think it's really important to touch on that. There's these challenges to BLS credibility, but actually, if you look under the surface, since COVID, since the pandemic, the response rates have really plummeted. So what happens is you get a phone call. Hi, are you employed? Or a company essentially is asked the same thing. And after the first month, and Ian, feel free to help me out, I think it's something like 60% of people respond. Pre-pandemic, those numbers were much higher. After the second month, it's in the 80s. After the third month, it's like 95%. So those numbers are more reliable. So the question I think to ask is, instead of calling companies and individuals, is there a better way to get more real-time access to data so that we're not always revising away the data, which absolutely calls into question the credibility of the BLS, which I think is helpful to no one.
Ian, do you have more faith in the inflation numbers that we're going to get next week, for instance? It doesn't get revised in quite the same way that the jobs numbers do.
Well, I do have a bit more faith on the inflation side because a lot of the inputs are real time. A lot of the inputs are not survey based, i.e. relying on someone or a firm to contribute. So there are questions about the methodology on CPI as well, but that's a separate issue. That's not a reliability of the data per se. I'm also concerned, because we do get the benchmark revisions for the BLS data on Tuesday, that we have more revisions coming on the job side that might have until now flown under the radar a bit, and that could be a bigger market mover than even CPI next week.
Okay, fair enough. Before today's release of the jobs report, Stephen Englander of Standard Chartered had said that, in our view, published NFP below 40,000, which is what we got, and an unemployment rate at 4.4%, which we did not get, will make a 50 basis point cut likely. How wide open is the door to a 50 basis point cut, Ian?
So I'll make the observation that we were pretty close to a 4.4% unemployment rate, because on an unrounded basis, it was a high 0.3. That being said, this report, I think, locks in an October rate cut as opposed to putting 50 basis points on the table. I wouldn't take 50 basis points off the table yet because we still have CPI and we still have those BLS revisions, and we could be looking back at the reference period and conclude that, in fact, policy was much more restrictive at that moment than we're currently assuming it was, and we're just playing a game of catch up with the economic data as we go into the Fed on the 17th.
Kay, how fast of an easing cycle could this be?
So we're more in the soft landing camp and expect the Fed to cut once in September, so 25 basis points. And if we continue to get this type of economic or this type of employment number, we would expect probably 2 more cuts, so call it 75 basis points. I think employment is the number to focus on. At Jackson Hole last month, Fed Chairman Powell made very clear he's more focused on the employment side of the dual mandate than he is on the inflation side. But I would agree with Ian, we absolutely will be watching CPI next week as well.
All right, good stuff. Herr of JPMorgan Asset Management and Ian Lyngen of BMO Capital Markets, thank you both so much. And a programming note that Chicago Fed President Austin Goolsbee will be joining Bloomberg's Balance of Power at 1:30 p.m. New York time today. Be sure to tune in then. Up next on Real Yield, the auction block. September starts at a sizzling pace for debt sales. We're going to talk credit next. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where global issuance got off to a sizzling start for the month of September. We start in Europe. Tuesday set a record for issuance in one day. Supply for the week coming in around 79 billion euros. That is the busiest stretch since mid-May. The numbers were helped by a record 10-year gilt sale in the UK. Now, here in the U.S., it was the second most active week this year, with more than $67 billion sold. Tuesday saw a record 58 bonds in the market. Big names included Citi, Merck, and Cigna. And over in high yield, the primary market priced almost $10 billion this week, including almost $5 billion on Wednesday, the busiest day in 3 months. Borrowing costs have fallen, hovering near levels last seen in 2022. Now, sticking with credit, Omar Aguilar, who's the CEO of Schwab Asset Management, says high-quality companies are pretty well positioned despite historically tight spreads.
Credit spreads have been incredibly tight, and most importantly, not only the level, but if you actually see the level of volatility of the credit market, it's actually very surprising to just see that even though we have seen all kinds of uncertainty coming from headlines and everything else, we've seen this done incredibly, well positioned for high quality companies where leverage has not been high.
Joining us now is Patrice Altongy. She is head of debt capital markets for HSBC Americas. Also with us is Matthew Mish, head of credit strategy at UBS Investment Bank. So as we kind of set it up, there's been a ton of issuance in Europe and in the U.S. There's a lot of supply. Patrice, let me start with you. What does demand look like right now?
Demand is still super strong. I know we've got a lot of news today out on the jobs report, but the technicals and how fixed income investors have been shaking this off has been pretty impressive. Oversubscription levels very strong in Europe. We saw a number of U.S. issuers heading over to that market. That's been a consistent theme. In fact, almost 25% of corporate supply in Europe is from U.S. issuers this year, and that's up about 5%. And in the U.S., the inflows are strong. They're strong on Lipper data, they're strong on ETF fund flows, and they're strong on broad ag flows. So there's really not a bad spot in the market right now when you're thinking about different tenors.
Matthew, what do you see? Because a lot of what people are saying is that there's this rush by investors to lock in yields while they can before rates begin falling next week, as early as next week if the Fed cuts.
Yeah, I think at these spread levels, you have to issue, right? And you're going to take opportunistically the chance given the amount of events this month. I think in general, from the client base, what we're hearing is, I think, an increased belief in a softer landing. And that really comes through even despite the jobs data. I think people think inflation boosts nominal earnings growth. Ultimately, that you're seeing a lot of this issuance mean that credit conditions are easing in the marketplace and default rates are still low. The latest data that we have on bankruptcy filings across the board is fairly benign. So to us, this looks like, and there's 6 periods in the past where you've had labor market data that is at or very close to kind of flatlining. And in half of those instances, credit spreads have essentially not moved. And it really has been those cases where the economic slowdown has really kind of bottomed and started to pick up. And so you've reaccelerated, and that's the expectation in the market. Or you've had credit events like 2007. And I think we see very limited signs of either of those evolving in the next few months.
Do you see any sign of complacency in where spreads are? I mean, they're pretty tight right now. Okay, I'm sorry, Miss.
No, we don't really see, it's a steady grind in. We did see spreads hit some tights before Labor Day. We saw a little bit of back off as issuers made room for the deluge that we're seeing now. But even with almost 70 billion in supply this week, we have seen those spreads start to grind in. And cash balances, we did an investor survey very recently, and investors are reporting that they feel that they have either high or very high cash balances. Almost half of our investors are reporting that. The other half say it's very normal, and like less than 2% felt like they were at low cash balances. So people are ready to go. They've made room for the supply that's coming. I think a lot of issuers have tried to pull forward some of their supply in early in the year. We've seen the banks fund a lot. They're mostly done. A lot of the corporates have done a lot of their funding, but technicals will remain strong. So I think when we look at the rest of the year, we'll see people trying to be opportunistic, taking advantage of these windows before 2026 to start on 2026 plans. And we're also starting to see the M&A calendar pick up. And fixed income investors love helping to fund M&A transactions. They're typically very large liquid deals. And it's a great place for them to participate.
Thank you, Patrice, and forgive me for butchering your name earlier. So, Matthew, put that all together with the steepening yield curve and the expectation that it will continue to steepen with this idea that we're going to get more M&A, we're going to get more activity as the year goes on.
Yeah, I mean, look, we generally have a view that the ranges are going to be narrow for spreads and that interest rates are heading lower. So from a fixed income standpoint, that generates pretty good returns, almost equity-like returns for the rest of the year. So depending on the specific pocket of credit, whether you're talking high grade, high yield, leveraged loans, or private credit, we're looking for a range of 2 to 3.5% total returns over the next 4 months, which on an annualized basis is 6 to 10%. I mean, that's very attractive returns. It's not without risks, but I think the two biggest risks in the market right now are, one, that the labor market deterioration actually gets worse, right? That we have to go through a period where maybe we're miscalibrating the magnitude of the slowdown. I think that could be problematic. The other thing really that people are focused on is the AI trade, and that ties in very closely with private credit. But right now, our view is the cycle extends. There's a very positive technical, we think, in private credit where the inclusion of alternatives in defined contribution plans is going to help drive more flows into the market. And there's a lot of optimism in capital deployment to the point Patrice was making on the private credit side.
How does that affect what you're looking at, the private credit and the demand for those instruments?
We're seeing a lot of the business development companies do a lot more funding into the bond markets, both in the U.S. and in euros. We had a great successful transaction there this week that Blue Owl did and was very attractive levels versus where they were in dollars. So a shout out to them on taking advantage of that opportunity. But it does flow into our market, and the investment grade markets are the most liquid in the world. Yep. So whether we think about AI needs and needs that companies will have for the future, a lot of that I think will get funded ultimately in the bond markets because it's the place where you can do 20 to 40 billion if you need to.
If you had to point to something that worries you the most right now, what would it be, given where spreads are right now? Matthew?
It really is on the private side. I mean, we wrote a note a few weeks back highlighting that there is emerging signs of deterioration in the credit quality. So it's not a public market story, it's a private market story for us.
Could that spill over?
It could, but I think our view has been very clearly it's not going to be volatility in interest rates in the medium term. It's not actually going to be economic growth unless we fall off a cliff. It really is going to be the question of whether or not the increase in default rates, which is marginal right now in that market, really picks up and accelerates. But our view is outside of an economic recession, the only other way that happens is if you look at the BDC portfolios, to Patrice's point, they're very concentrated in several sectors, two of which are tech and services. So we're watching it closely, but right now the signs are not for an acceleration in defaults. And if that's the case, you don't get a surge in cumulative default rates in that market, you're not going to see much spillover. If anything, that market will continue to be a shock absorber. So if you get public markets or confidence to fall, public market issuance tightens up, you'll see private credit step in.
Okay, that's a really good something to watch for. Patrice, what about you? What worries you the most right now?
Yeah, when we talk to investors, the top 5 things have been U.S. fiscal policy, the deficit, inflation.
The usual.
Geopolitical tariffs, like U.S. weakening economic conditions have been at the bottom of that. Whether today's report starts having that, come up a little bit in their concerns, maybe, but, it is still a number that people are working through. Investors, it's not stopping them. Maybe they're thinking about it a little bit differently, but it hasn't slowed down the market from our perspective, but definitely something that we're watching.
Gives them something to think about, but not enough for them to pause.
Correct.
All right. Patrice and Altongy of HSBC Americas, thank you so much, along with Matthew Mish of UBS Investment Bank. And if you can't get enough talk on credit, be sure to check out the Bloomberg Credit Edge weekly podcast on the Bloomberg Terminal and wherever you get your podcasts. Still ahead on Real Yield, the final spread, the week ahead, the last full week of data before the Fed's September meeting. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the final spread, a look at what's coming up in the week ahead. And on Monday, Japan and France hold confidence votes. Questions about political stability, particularly in France. Also over in China, trade data is released. On Tuesday, here in the U.S., Apple holds its annual iPhone event, plus a UK bond sale, especially with a lot of bond vigilantes being irked in the UK. And there's also earnings out of Oracle. On Wednesday, we get the start of inflation data reporting with US PPI coming out. Also, Ursula von der Leyen's State of the EU Union address coming out that day. That sets us up for the ECB decision on interest rates on Thursday. That coming out at 8:15 a.m. And then U.S. CPA data. That is the big data point for the Americas and the 9/11 memorial services. And then we cap off the week on Friday with the University of Michigan sentiment survey and inflation data out of Europe. And for my final thought, I want to take a look at CPI estimates, looking ahead to that print, because right now the consensus estimate is for a pickup on the headline number of 0.3% from the prior 0.2%. When you back out food and energy expenses, it'll stay stable at 0.3%. On a year-over-year basis, core will be 3.1%, sticking with the 3.1% prior. When you strip it all out, we're looking at inflation that is still above the Fed's 2% target. That does it from New York. Here for Real Yield. Same time, same place for us next week. This is Bloomberg.